Today we're going to talk about forecasting the FX risk of the balance sheet, which is very challenging for a lot of companies to do. And the reasons that they need to do it may differ depending on their accounting rate methodology or the ways that they do it. So we'll distinguish between a few different popular accounting rate methodologies. One is setting your accounting rate for your transactions for the month at the prior end month-end spot rate. And another one is using the daily rate. So the daily rate is the same as a weighted average rate for the current transactions for the current month. And whether or not you're using one or the other may determine whether you're even having to forecast the balance sheet for an FX risk perspective or just trying to hedge your actual exposure step by step along the way. And we'll talk about some other pros and cons of those two accounting rate methodologies. So I'll first focus on forecasting your balance sheet risk when you're using the prior month-end spot rate as your accounting rate for the next month's transactions. When that's the case, you have a pretty clean handoff between the income statement risk and the balance sheet risk. And folks that have that methodology tend to need to forecast the future balance sheet and often have a lot of trouble doing that. That's often something that's spread out amongst the globe. A whole bunch of different people might be submitting a balance sheet forecast for their entity or their currency that they're responsible for. And they're not really well equipped to do that. They don't understand the whole picture. And so that often is not a very successful process, and the forecast deviation can be very, very high. So in order to have a more successful process, it can be advantageous to leverage income statement forecasts that are already happening at the company. So typically the FP&A organization is rolling through income statement forecasts at least once a month, maybe updating those more than once a month. Gets a lot of visibility through the company as folks want to see the revenues, expenses, and all that forecasted on a very frequent basis. The foreign exchange breakdown of that might not be sufficient for Treasury for hedging all the currencies. It might be by region and by quarter, and Treasury needs it by month and by currency. So there may be some modeling needed from an existing income statement forecast, but it's usually a good idea for Treasury organizations to leverage what is already being done and what's more accountable at the company with those income statement forecasts. So there tends to be less forecast deviation, and it tends to be an easier way to get to your next month-end balance sheet by building off of your last known balance sheet with income statement inputs. So on our first chart here, we have an example of kind of that build methodology or an indirect method of getting to the balance sheet. And what you do is you start with your last known balance sheet. So if I'm coming up on my month end and I'm near my remeasurement rate and my accounting rate that's going to set, and I don't yet know that current month's balance sheet, I may have to go back to the prior month end balance sheet as my actual and my starting point. And to that, I'm going to try to anticipate how I get to the current month end balance sheet. And that's going to involve understanding your income statement inputs, revenue, COGS, OPEX, at least the items that feed into the balance sheet. So to the extent that revenues will become receivables, some expenses will become payables, maybe not everything. You could have COGS that disappears into inventory that doesn't remeasure, so that's not a balance sheet item that you have to worry about. So understanding the dynamics and the flows from the income statement to the balance sheet is important. And so you have a forecast of those for the current month, and you want to forecast those for the next month as well. So the balance sheet is going to build from the last known through these income statement inputs. The other piece you need to understand are any cash trades that are done during the current month. So if you have maybe excess transaction currency that's not in the functional currency of an entity that gets converted to the functional currency of that entity, you have to take that into account. Or if you have funding needs and you're sending, maybe the parent is sending local currency to an entity that has high local currency expenses and no revenues. So those liquidity trades need to be understood and are hopefully dealt with via FX swaps and not spot trades, especially if you have a month-end rate, accounting rate setting. So a lot of this is kind of complex and understanding the ins and outs. A lot of folks make it harder on themselves trying to forecast maybe exactly where a balance sheet is going to end versus kind of building up to that balance sheet with the income statement inputs and doing even swaps to manage any trading that's done and in control of Treasury throughout the month. So if you're doing spot trades for that purpose, you're probably introducing more balance sheet risk and noise than is necessary. So that first chart just kind of summarizes, without getting into all the detail, and you can certainly give us a call if you have questions on that detail, how to kind of build your balance sheet forecast in this indirect method. Now the next chart kind of shows the difference in the accounting rate methodology and how that can impact where your gains and losses hit on the income statement and how it affects your balance sheet hedging. So as I mentioned, the two most common accounting rate methodologies are your spot rate at the end of the prior month or a daily rate, kind of the same as a weighted average rate. From these charts you can see there's really this timeline for the entire cash flow of your income statement and then the balance sheet. So there's a handoff from one to the other where there's a month-end accounting rate methodology. It's a very clean handoff, and folks that have been in companies that have both types of accounting rate methodologies usually prefer that. It's a lot less transactional, cleaner to close off your income statement hedge and hand off to the balance sheet. For folks that have the daily rate, ideally or theoretically, you'd be trading every single day as that activity goes on and off the balance sheet and ends from the income statement. So it's more difficult to close out your cash flow hedges or your income statement hedges, or more administratively burdensome to execute your balance sheet hedges. Ideally, you're looking at your balance sheet every single day and then having to react to that, and where there's a difference between your trades and your actual balance sheet, you need to true it up. In practice, a lot of folks don't want to execute every single day. They may do it weekly. They may wait until a certain difference between their hedges and their exposure breaks a certain threshold, and then they'll react. But it's a lot more burdensome to do that. The folks that are subject to that daily accounting rate may not be therefore forecasting their balance sheet at all, but they may be missing out on some items that get booked at the end of the month, but at an older rate. So certain things that where the balance sheet is not really updated every single day for all accounts. It might be updated for receivables and cash. As revenues become receivables every day, that's happening. But a lot of expenses may be accrued or booked during the month end. Certain entries, maybe some tax-related items, could get booked and backdated to an older rate. So if you're not forecasting at all, you could be missing out on that and creating a lot of volatility there. So pros and cons of the different accounting rates: a lot less transactional if you have the month-end rate compared to the daily rate. And also the geography of where the FX impacts hit your income statement is more favorable in that environment. If you have the month-end spot rate, all the noise for that month hits OI&E on the balance sheet side and is purely tackled with balance sheet hedging. If you have a daily rate, you kind of have this handoff slowly, bit by bit, every day of the month as the income statement exposure goes away and it gets handed off to the balance sheet. So you have that, not a straight line in between the two, but the kind of that diagonal line we have on this chart that shows that income statement risk transitioning to the balance sheet risk. If you're trying to forecast a balance sheet, there's several things you need to understand. You first of all absolutely need to understand your accounting rate environment and what methodology is being used. You need to understand, of course, your forecast and any forecast deviation, and the easiest way to do that is to understand the income statement input. So it's important to understand all those items if you're going to successfully forecast your balance sheet.